Let's look at some leveraged ways to trade the S&P 500. First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. If you are feeling bullish, you have the plus 3x ETF here, which is up huge, 259%. If you are feeling bearish, then you have this one, and that one is very far away from the highs. To get a bit of a quick overview, you see here that the S&P 500 is 63-ish% here from the lows. You see that there's a big difference between the different sectors in a rather major way. Tech software is furthest away from the 52-week low, 668%, pretty huge. Looking here at the megatrends, you see definitively a mix, though overall, we have some very, very substantial moves. Hence, there's been a very strong bullish sentiment so far in the markets. So we will look at the SPI as, the benchmark. XPL is the bullish, leveraged ETF, and then you have XPS if you are feeling bearish. So what I have done here with these blue boxes, that is to draw in previous times going all the way back here to the early 2000s, where we traveled from a key low all the way up to the high before we tested the red 200-week moving average. So here we have, 103% over, 1,800 days. This was leading, this was from the bottom of the dot-com bubble to the financial, the housing bubble highs. But the percentage move wasn't really that dramatic. Here, after the financial crisis, let's zoom in a bit. You see that we moved 105% in 784 days. A big move in a shorter time frame than this, but it was also from a lower level. Let's zoom in a bit like that. And here you have, this period, which stretched from, 2011 to 2015. Then we are 97-ish%, 1,300 days. So that was more a protracted period, 61%, approaching 1,000 days, 413 days. And then we have the current rally. So we have rallied 86% in 378 days. So when we look at the percentage move to the upside, 86%, it is, one of the higher rallies we have seen, percentage-wise. When we look at the number of days we took to travel, it is the shortest time of them all, okay? Of all the prior times, this is the shortest time. So when you take into account both the duration of the move and the extent of the move, then this is, scientifically and objectively speaking, the most euphoric rally we have had ever since, the early 2000s. That is significant. So when you hear people say that this is a bubble, and it is, scientifically speaking, looking here at the numbers, it is a fact. This is it is more of a bubble than what we have seen before. But the tricky thing about bubbles is that they do eventually correct in a very big way, but they are very difficult to short as well. But they're also dangerous to be recklessly long, and that is why I'm a huge proponent of having a market-neutral portfolio. Which is why in the videos and content I publish, you will see that I present bullish and also bearish opportunities, even through this rally. Okay, so when we look at some indicators here, one indicator that is pretty key, that is the PPO, and that measures the distance between price and the red 200-week moving average. So here you can see it draws a line, and we have not been this far away from that key moving average since, how far do we have to go back? Well, we literally have to go back here to the early 2000s, the dot-com bubble. So that is also, a clear sign that this current rally, it is the most euphoric one we have seen in a very long time. Looking here at the RSI, we are at a very high level. You see that historically we have a strong tendency to pull back on the RSI. That has been, the primary trend. There's been a few periods where we have stayed elevated for a protracted period. Though if we do look at some of the previous periods, here you see that we had this protracted period. But what happened after that period was that we had a relatively long period of a very messy market. Here we stayed overbought for an extended period of time. Like this, a bit of a messy drawing, but you can see that after that high, we had a very messy market. Huge. The bears came back in a very big way. So that is just a risk. Here, we were, interestingly, before the lockdown plunge, we were very overbought. Hence, if you, had a market neutral portfolio and you initiated bearish positions based on overbought levels, then you could, before this plunge, which was very dramatic, limit down markets, you could have a market neutral portfolio, and without knowing that this would happen at all. You simply saw that we were just very overextended, so you wanted to have a more balanced portfolio. This crash happens, and you don't have, flaming red numbers in your accounts. So yeah, market neutrality, it is, one of the few ways to generate alpha. Looking here at the daily data points. Let's zoom out a bit. Here we have the distance between the red 200-day moving average and price, and you can see that it's rare for us to be this far away. So even on the daily data points, we have very clear signs of excess. The same with the RSI. It is rare for RSI to go very high into overbought territory. Looking at the seasonality, it does suggest that April could actually have even more strength. It tends to close higher 80% of the time, so there's super strong seasonality here for April. But that also means that in April could be the best time, to initiate some kind of bearish position. That some super euphoric high will be made in April, because you can see that the seasonality gets significantly weaker heading into June. Finways, they draw this trend channel. We have tested the upper range multiple times, and it has triggered pullbacks. And we are, not that far away from testing it again. And this is April, so we could have that test in April. And historically, it has been, a reasonable time to be a bit bearish. When we compare the S&P 500 with the China ETF, SPXL, looking at the price to earnings, then you do see that China is, trading at a minus 40% discount if you look purely at PE. Okay, so looking long term, I would say that I'm feeling a bit more bearish on the S&P 500. Though it is a bubble, so we gotta be very careful about initiating bearish positions on a bubble. On a bubble, you should at least have a very tight stop level. Looking at the shorter time frame as well, I do think that this is, objectively speaking, we have looked at the data. We haven't seen something like this in a very long time on the S&P 500. There's clear signs of euphoria. Yeah, I'm feeling bearish. But you definitively want to have a tighter stops. And April could be the time, given the seasonality, where a very, very good risk-reward bearish opportunity comes up on the radar.